Hello, everyone. Today on the final bar, I'm Dave Keller, Chief Market Strategist at StockCharts.com. It's Monday, April 10th. We're going to talk about the market conditions here. The mega caps really struggling today on a relative basis. Let's dig into the charts here on our market recap and see what we can find. As I mentioned, the major averages struggling a bit, but it's really driven by the mega cap stocks, and we'll hit on those here in a minute in our market recap. But just to start off, the Dow up about 0.3%, the S&P 500 finishing just narrowly in the green, but that really happened in the last 20 minutes of trading that it went net positive, closing the day just below 41.10. Earlier in the day, it was down as much as down all the way to 40.75, so nice recovery there in the afternoon. Nasdaq Composite actually finished narrowly in the red, and most of the day spent in the negatives. Mid caps and small caps did just fine. That's really the nature of the types of stocks and the type of sectors that were performing well. REITs actually finished in the top three sectors as well, along with industrials and energy. A lot more representation in the mid cap and small cap indexes in those sectors versus the large cap indexes, and that's why those smaller cap tiers like mid caps and small caps doing a little bit better. Then the S&P 100 was actually down 0.2%. The VIX pushing a little bit higher, but still well below 20. Right, it's just around 19. It's interesting how the VIX has remained really low, even with, I would guess, what I would perceive as a lot of market choppiness, to be honest with you. And I should have set this disclaimer at the beginning of the show. Here, the Monday after the Easter holiday, a lot of non-U.S. markets are actually still closed. So in general, volume's a little bit lighter in global equities. And that's certainly, I think, informing a little bit about what you're seeing with the U.S. markets. At the end of the day, not much of a change. That's probably right, coming out of a long holiday weekend. Again, with a number of markets struggling or remaining closed while the U.S. markets were back open today. Interest rates overall pushing to the upside, short term all the way to long term. One of our questions in the mailbag after the break today deals with the yield curve. I'll tell you a little bit more about my interpretation of what we're seeing here, but the short end certainly remains fairly elevated relative to the rest of the curve. That's that inverted yield curve we've talked about. But across the curve from short end to long end, all moving higher as bond prices actually moved lower today. The dollar moved up a little bit, 0.6% higher for the UUP. Commodities overall mixed. You're seeing gold and silver both net negative. Gold stocks actually one of the worst performing groups across the U.S. equity space today, with stocks like NEM, Newmont Mining in the worst performers list. The GLD was down about 0.75%. Other parts of the commodity space doing just fine, though, particularly energy. Finally, cryptocurrencies, a lot of green here. And if you look at the chart of Bitcoin, you'll find that 30,000 is getting closer and closer. Ether prices almost to 1,900. We've talked about the importance of those big round numbers, just like we look at the S&P and where it is relative to 4,000 or eventually 5,000. Looking at Bitcoin at 30,000, Ethereum at 2,000. These big round numbers have meaning because that's where humans kind of naturally look at an asset. And you start to think, right? If Bitcoin goes above 30,000, that's when it's sort of like a come to terms moment with what you've seen, right? Is Bitcoin really worth more than 30,000, right? For $30,000 per Bitcoin. That's when the market forces you to sort of reconsider your conviction and your assessment of that market going into that point. So some big important numbers to pay attention to on cryptocurrencies for sure. Let's dig a little deeper into a daily chart of the S&P 500 and see what we can see. So not much change, to be honest with you, because today's bar looks suspiciously identically like the bar from last Thursday. Friday, we were closed, of course, going into the long holiday weekend. But Thursday, which was the end of last week, having a similar lower open, higher close type of configuration. Also on lighter volume today, you're getting a little less volume than normal. You're having a sort of continued pattern that we saw there. So what that tells you is there's no real distribution happening. Overall market conditions are remaining fairly stable. Over the last week, the market is saying that the S&P is worth about 41.10. That's about where it should be. That's what we reached about a week and a half ago. We remain there at that same level. So what this tells us when the market is sideways and the market's in equilibrium is generally buyers and sellers are in agreement as to where this thing should be at. What happens, and after a period of lower volatility, when the range is kind of coming in, this is a John Bollinger trick. If you think about the Bollinger Bands, they fluctuate from wider to narrower depending on the volatility. So when you've had sort of this noisy, choppy market and it kind of comes into this range, this lower volatility range, you're basically, it's the calm before the storm. You're waiting to see which way we would break. Do we break out of this pattern to the upside? Do we break out of this pattern to the downside? What's interesting is right now, you have some upper and lower boundaries to speak of, right? Up just above current levels, 4,200 was the high from February, and really around 4,150 is really getting to the upper end of that range. On the lower end, we have the 50-day moving average currently around 40.30. Below there, we have the 200-day moving average around 39.45. See which way this price breaks. Do we break out of this pattern to the upside or out of it to the downside? That could tell us a lot about the potential future path for the S&P after we break out of this sort of sideways consolidation phase that we've been in. But make no mistake, last week has been lighter volume, sort of consolidating, sort of an equilibrium. And that means we're getting ready for a move one way or the other. In terms of sector leadership and what happens, let's talk about sectors. And then I want to look at a couple of the mega cap stocks, kind of tell the story of where we're at right now. On the upside, for most of the day, it was the MEI sectors: materials, energy, industrials. So these are sort of the late cyclical leadership. And what I mean by that is usually at the end of the economic cycle or the business cycle, sort of the late things, the things that tend to lead before the bear market, generally speaking, are those kind of sectors, right? Energy, industrials, sort of like the late leadership. Then when things start to get ugly, again, you have leadership from more defensive sectors like utilities, or real estate, or like staples or something like that. So at this point, it's some of those cyclical sectors that are doing pretty well. REITs were actually in the top 3 as well, up about 0.5%. Only a couple sectors in the red, and not by much, to be honest with you. As I mentioned, sort of a narrow range from best to worst when we look at the 11 sectors. On the downside, we have things like communication services, utilities, technology that are all kind of at the lower end of the return range. Let's continue on looking at what I call the phenomena stocks. Now, the phenomena stocks are basically a group of 8 stocks. Think of these as the FAANG and FAANG-like stocks. And let's maybe look at a better view of this. This is a summary view of this list of names. So the phenomena stocks are these 8 stocks, right? Meta, Amazon, Netflix, Apple. You can see the letters that we're picking out here for these 8 stocks, sort of FAANG and some similar names. Look at how most of these are actually down today. And again, while the fact that Apple's down 1.6%, Microsoft down 0.8%, these are not end of the world bear kind of movements today. But it does tell you that when these stocks are down, even by that much, it's really hard for our major benchmarks, which have such a weight, are weighted so heavily toward these names. When these names are struggling, it's just unlikely that the broader market, the broader indexes, certainly our growth-oriented benchmarks, are going to do well. And so that's what was sort of lagging. So even though materials and kind of industrials and energy and real estate were doing okay today, actually having a similar move to the upside, there's so much more market cap in just these 8 names that those sectors doing well will be overweighted by these sectors doing poorly. And that's kind of how the market evened out to a flat move for the major benchmarks. You know, Alphabet down 1.8%, Apple down 1.6%. When we look at the chart of Google, not a bad chart, right? And if you take just today's drop out of the picture, Thursday on the close made a new closing high for the year, very close to retesting the closing high from February. We're at the upper end of the range that we've been so far in the first quarter of 2023, now beginning the second quarter. So this is a decent chart and sort of a little mini cup and handle type of pattern here, arguably breaking above that neckline. And again, some of the larger names are showing these beautiful continuation patterns. NVIDIA was the one that I was asked about earlier today. Just a consistent, strong uptrend. This is NVIDIA for the last year. Look at the left half of the chart, which is through October of 2022, and look at the right half of the chart, which is coming off of those October lows. Just a clear rotation from a distribution phase of weaker trend to an accumulation phase of a stronger, more bullish configuration. So you're seeing a small subset of the equity space look strong, just like the chart of NVIDIA or the chart of Alphabet. That is what is allowing our benchmarks to, I would argue, look a lot better than they probably would. If you had an equal weighted S&P, which would be SPXEW, you find it's a lot less attractive of an overall trend because of the weakness in some of the other areas of the market so far. Just to finish off here, I want to bring up the Mindful Investor Live chart list because we have a series of charts that talk about market breadth. And I just want to check in on where we're at relative to some of those key measures of market breadth here. When we look at the advanced decline lines, again, when I talk about this market sort of in a sideways configuration, I'm reminded of my conversation with Dave Landry last week, right? Dave literally he used to sketch out on a cocktail napkin. His joke at a presentation was never have a trading system that you can't sketch out on a cocktail napkin. So he would pass out cocktail napkins with 3 arrows: uptrend, downtrend, and sideways. And it strikes me when I'm looking at this chart of the advanced decline lines for the New York Stock Exchange, for large caps, for mid caps, for small caps, it is sideways, right? I mean, look at the advanced decline line over the last 12 months. We're kind of right where we were in April of 2022. So 12 months later, even though we've had a lot of movement, the trend overall is fairly sideways. The 50-day moving averages are kind of choppy, but net neutral right now. And a lot of these are right around their 50-day moving average. So again, you have this impression of a market that's sort of settling in. And while that's encouraging, I guess, that we've at least reached an equilibrium and there's no drastic moves, this often comes right before the big move, right? Sort of the calm before the storm. And that's going back to my comments about John Bollinger. He used to say, thinking about the Bollinger Bands, when the Bollinger Bands would narrow, when there was that lessening of volatility, you had to sort of be ready for a big move in one direction or the other. That may be what we're setting up for. Overall, I don't know if there's a clear direction implied by the charts that we're seeing, because I would argue that depending on what part of the equity space you're looking, things are actually either pretty encouraging or actually pretty frustrating. Breadth that I'm looking at in terms of the percent above their 50-day moving average, net almost exactly at neutral, 49%, which means half and half of the S&P above the 50-day, half below. Let's take a quick commercial break, and we'll be coming back after the break with the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close for our show, and especially thank you this week. I'm actually on spring break with my family down in the Columbia River Gorge, and if you don't know about this area of the country, the Pacific Northwest, the Columbia River is a huge river, and the Columbia River Gorge is sort of this area all along the river from the Oregon coast, much inland, and we're over by Mount Hood. So we're dealing with some interesting technology issues for the first time. So thanks for hanging with us as we figure out the best way to keep bringing you this great show every weekday after the close. Just to let you know about some of the conversations we'll have this week. On Tuesday, April 11th, Chris Shavacco of Shavacco Capital. Chris is a great thinker. He's a successful money manager, but also just a really thoughtful strategist. And we'll love to see what sort of charts he's looking at right now. Mark Newton from Fundstrat Global Strategies in New York is going to be joining us on Wednesday the 12th. Then on Thursday, the 13th, our friend Mish Schneider of Market Gauge will be joining us. Always a pleasure to talk to Mish, former trader in the agriculture space, now covering a lot of different stocks and asset classes. Always brings some thought-provoking charts as well. Also, just to let you know, this show is fueled by viewers like you, and we really appreciate your questions. We're going to do a mailbag segment here in a few moments. We're going to do another one at the end of the week, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We would love to hear from you, and we hope to answer one of your questions live on the air on Friday's show. Let us continue on our show today with the Final Bar mailbag. Please keep your great questions coming to us. And let's get to question number 1. Dave, how can I create a chart with a 5-day and 15-day RSI on the same panel? You mentioned you're using another charting platform. I welcome you to the world of StockCharts.com, and I'm happy to show you how to set something like that up. So here on my basic chart, when I bring up a stock like Disney, I have the price with moving averages, I have the RSI, and I have relative strength, really, relative performance of the stock versus the benchmark. That's my default chart. Your chart may look a little different. If you're using Sharp charts, by the way, you can configure all of this just below the chart. Heads up, we're actually in the process of testing our new version of Sharp Charts called Sharp Charts 3.0. We will be unveiling it to you later this year. We've been testing it internally. It's a really cool user interface upgrade. The Stock Charts platform has looked a very similar way for quite some time. It's very easy to change the settings, but you're going to love the new look and the new capabilities of our new Sharp Charts platform. Really, really cool. You're not going to lose any of the cool stuff you get to do. It's just going to be easier to use. Having said that, here's how you do it now. At the bottom, you see where I have indicators, and I have RSI, and I have price performance. So what I'm going to do is make the second indicator RSI, and I'm going to give a different period like, 5 or something. I know you asked about some different settings. So I think you said 5 and 15 days. So let's do that. What you have to do is you have to use these drop downs a little differently. So here you have RSI 15 day is just below, then RSI 5 day, and I'm going to say behind indicator. I may want to make this a different color just so I can make these a little easier to see. So I'm going to make the first one blue, the other one pink, and I think the rest of that should be okay. Now, if you look at what I've done, I've basically created this chart where I have both the RSI 15 day and the RSI 5 day overlaid on one another. And by using these different settings, blue and then pink, and changing the colors, you can see that I can do it. If you don't set a color, it does that default where it's like green and red, depending on whether you're overbought or oversold. But if you're going to do multiple indicators on the same chart, I find setting a color for each one is a little easier to just differentiate them. You also might want to mess with how opaque or how transparent some of these indicators are. So if like the blue one's a little too bright, make it a 0.8, which means it makes it a little faded out a little bit. So maybe they move. So by changing the colors, by changing the opacity or opacity, opacity, I guess is how I pronounce that word, you can change how these things appear and actually change the look of the indicator. The ACP platform has the exact same capability. Just make sure that you use this setting that says behind indicator. On ACP, you can actually drag the indicator on top of the other indicator just with your mouse. Just click on the little legend, drag the one indicator right onto the other, and it'll work just fine. Actually, I was messing with that before the show. We'll see if I can, different indicators, but you see if I do that, it's going to overlay the indicators on each other. Yeah, I'm not doing it well because I have different ones, but trust me on this one. Do both of them as RSI, and you can drag them one on top of another. They'll embed them right on the same ones. Just use that same trick of messing with the colors. It'll be easier to see the different indicators that way. Great question. Thanks so much for asking that one. Question number 2, banks make money by borrowing the short end and lending at the long end of the yield curve. If the Fed increases rates, doesn't this increase both ends so that banks' margins stay the same? So that's a really interesting question. The answer is yes and no, and the longer answer is a little difficult, but I'm going to get into it as much as I can. I will be honest with you, right? We cover a lot of different financial topics on the Final Bar. I try to keep them accessible and simple, but also not sort of dumb down the details, right? Because a lot of things can get a little more complex. And the interplay of the yield curve is a surprisingly complex thing. And I will tell you that there have been numerous academic studies and strategists that have opined on how the yield curve actually functions. It's not as clear cut as you might think in terms of how different things like the Fed changing rates, what that actually does to the entire yield curve. That's actually the subject of great debate at conferences that I might attend that you probably don't want to. Having said that, here's the thing, right? When you were talking about the yield curve, I think the best way to look at that is go to charts and tools. And on the right, there's a thing called the dynamic yield curve. That's the place on StockCharts.com where actually you can visualize the entire yield curve from short end to long end. And you can actually compare that to the S&P 500. You can click on a period of time. And if you go to like mid 2021, you'll see what's called a normal yield curve, which is the short end is fairly low. The long end is very long. Now, your question says if the Fed increases rates, doesn't that increase the curve, right? So the short end is higher and the long end is higher. And the answer is no. The Fed actually just directly controls the very shortest end. Basically, the rate that banks are borrowing from each other essentially is what they are actually changed. It's called the Fed funds target rate. And they also do things like the discount rate and things like that. So they're actually just messing with the very, very short end of the curve. Now, what they do certainly has ripple effects, because if you're a bank and you're actually trying to make money, you're indeed correct in terms of how you laid it out. They borrow money from other banks down here at the short end, and they're lending out to the long end to consumers so that you can buy a car or buy a house or start a business or whatever you want to do, where you need to borrow money and pay it back over a longer period of time. That's how a bank, generally speaking, on average, kind of makes money. So when you get to where we're at now, this is why it's a tough environment for banks, because the yield curve is inverted. So they're borrowing at this rate, but they're able to lend at a much lower rate. So you're right. Would it make sense for banks to raise their own rates on borrowing so that they can still make money? Yes, but here's the thing. If they make it more expensive to borrow money, less people borrow money, less people spend money. And this is how the Fed is actually trying to slow down the economy to address inflation. By raising rates, they actually make it more expensive for you to spend money or to borrow money. And as a result, you're probably spending less or doing less things, or, generally speaking, that is the argument. And that's why it tends to happen. Why is the long end of the curve so much lower? What you have to remember is the Fed does not directly control the long end of this curve. It's really driven more by free market forces, and it's more about investors and their expectation for economic growth going forward. So the fact that the yield curve is inverted, and the reason why it often comes right before recessions, and if you don't know what I'm talking about, have my tune into my show last week with Tony. We had a really good conversation about that yield curve inversion, things like money supply and other charts that Tony brought with him. But if you think about it, this is basically the market pricing in a lack of economic growth going forward. This is basically people not being so optimistic about the economy growing. And that inversion is the reason why that it often predates a recession, because this tells you that bond investors are actually pricing in a slowing economy, which is kind of what the Fed is trying to do. So that was a long-winded answer of a way of saying, no, the Fed only controls the short end, not the long end. The long end actually moves for a lot of reasons. You're correct in how the banks are trying to make money, but the yield curve, again, as a whole, everything I just told you is sort of generalizations about it. There are a lot of different forces that cause yield curve to fluctuate, which is why this dynamic yield curve can be really helpful to just see what the yield curve looks like, what it's looked like over time, and how that is related to equity performance. Really good question. And thank you so much for giving me an opportunity to weigh in a little bit on the finer points of yield curve analysis. Let's get to the next question. Dave, I see that Amazon has found support at the 100-month simple moving average. Is that something technicians use? Let's bring up the chart here. So I'm looking at Amazon. I'm going to bring up my monthly chart, which is this one. There we go. And I'm going to add, you said a 100-month. You can see I have the 12 and 60-month moving averages. So I'm going to add a third one and make it the 100-month as requested. And your comment was, check it. Amazon is actually finding support at its 100-month. This is in green here, the one that you asked about. I'm also noticing, as you may have, that at the 08 low, Amazon also found support at its 100-month moving average. Your question really got to, is this something that technicians use? And my answer would be no. Generally speaking, the 100-month moving average is not one that technicians tend to use. Here's the thing with moving averages. What I have found, and what I would say most technicians sort of come to, is there is a set of moving averages that you kind of come back to, right? And so for me, when I'm looking at a daily chart of Amazon, I have the 50 and 200-day moving averages. And these are the ones that I've always looked at. I always have them on here. If you look at Grayson Rose's charts, he usually has the 21-day EMA, the exponential moving average. He often has the 100-day simple moving average on his charts. I don't have those because for me, this is the way that I've just come to look at charts. And these are the ones that I come to use at. I've had people swear by the 5 and 20-day moving averages, the 150-week moving average, the 100-week moving average, and now you're asking about the 100-month moving average. I would be careful about how much you change moving average settings. And there's an issue called curve fitting, right? If I look at the chart of Amazon and find the perfect moving average, all I'm doing is basically fitting a moving average to the historical data. And that may be a great way to do it, right? I mean, but there's no guarantee that the 100-month moving average is going to continue to be a really effective way to find support. So the short answer is no, I don't have a lot of people using that. I'm certainly going to be following it on the chart of Amazon to see what happens, but I will stick with the ones I tend to use, which are the 12 and the 60-month. And the fact that the Amazon's below both of those is less encouraging to me than the fact that we're remaining above the 100-month. As always, though, experiment with settings. Find the charts that work for you. And that's why we have chart lists. That's why you can save your own settings and see what you find that works for you and your investment process. Folks, we have to wrap the show. There's a really good mailbag. We have a lot more questions. We'll get to more of them through the course of this week, but we need to go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Chart number 1 is Amazon. When I was actually asked about the monthly chart of Amazon, I was looking at the daily chart of Amazon as I was getting it started. And just, again, I'm coming back to the fact that these mega cap names are so important for our benchmarks, right? Those 8 phenomena stocks that we talked about earlier, it's all about what the price does relative, or really how those mega cap stocks are performing relative to everything else. When those larger names are doing well, our benchmarks just are much more likely to do well. It's really hard for the S&P and particularly the NASDAQ to go higher when these mega cap names are struggling. So when I'm looking at a chart of Amazon that is below its 200-day moving average, that's been below its 200-day moving average since December of 2021, I'm seeing a stock that certainly has not improved to the point that I would loosely describe it as bullish. When I'm thinking of charts to use to sort of make sense of this market, we're certainly in a transition period. We're in a period of lower volatility. The major averages are sort of settling in on lighter volume. what comes next? I think a chart of Amazon might be an important one to watch because we're sort of in this no man's land between the two moving averages. One of these two things is going to happen probably pretty soon. Either we break above the 200-day moving average, and if we would do so and follow through, that would be the first time in over a year and a half that we've actually done that, or we break lower and we break down to 90. And if we would not hold support there, that is what a new down leg for the major averages would look like. I think on the chart of Amazon is trading down to support and failing to hold. So right now I'm looking at that range around 90 to 110 on Amazon to see which way it breaks first. I think that could be a really important chart among many to try to watch. Let's get to chart number 2. When I was looking at the breadth by cap tiers, I'm struck on this chart by how sideways these have been, right? If you look at the major averages like the S&P, we've talked about where we're at relative to the historical trend. But when I'm bringing up the advanced decline lines over the last year, they were remarkably flat. Now, what's interesting is you can draw a trend line off of those lows. These red trend lines are trend lines that we were tracking earlier. We watched how all 4 of these advanced decline lines broke down through trend line support when they also broke their 50-day moving averages, but the advanced decline lines now have recovered them. So just like the chart of Amazon, I think watching these AD lines could be really important as well. Do we break above the February peak, or do we break below the March lows? One of those things is probably going to happen maybe sooner rather than later. And I would argue whichever way those break, that could be really meaningful. Especially could be interesting to watch the small cap advanced decline line, because small caps have certainly been lagging. While the mega caps have been doing much better, the average small cap stock has been struggling. Can the advanced decline line for small caps actually improve from here? Get back above the 50-day, get to a new high for the year. If and when that happens, you will hear me becoming way more bullish in my thinking and talking, because we will have follow through from some of those smaller, more higher beta, higher risk names in the market. Finally, I'm struck by the fact on our third chart in the 3 and 3, how it's about 50-50. It's currently 49% of the S&P members above their 50-day moving average. That means about half are below their below, half above. Now, what's interesting about that is, again, you think about all the narratives, you think about the seasonal strength in April, we think about the conversations I had last week with Jeff Hughes talking about sort of the bearish Elliott wave setups, talk about Tony Dwyer about money supply and the yield curve and sort of the negative macroeconomic indicators. At the end of the day, it's a 50-50 split on how many stocks are above or below their 50-day moving average. That's one of those basic measures of the overall strength of the equity market. So looking to see where we go from here, I think is really important. So the way I would summarize the 3 and 3, I think we have the chart of Amazon, we have the advanced decline lines, and we have this breadth indicator, the percent of stocks above their 50-day moving average, all kind of neutral right now. All 3 of those most likely start to move to the upside or the downside. I would love to see which way these break. While the seasonal tendencies tend to be stronger, I'm going to wait for the proof to be given in the form of price action actually moving higher. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. All of our previous interviews and some great specials can be found at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you again tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.